Imagine waking up every morning with one mission: compound everything: your money, your knowledge, your relationships, your entire life. That's the quiet obsession that turned a kid from Omaha into one of the richest and most respected investors in history. But here's the twist. The real story of Warren Buffett isn't just about money. It's about discipline, humility, heartbreak, mistakes, obsession, and a lifelong philosophy built around one simple idea: start small, roll consistently, and let the snowball grow. Most people see Warren Buffett as the cheerful billionaire who loves cherry Coke and still lives in a modest house. But the snowball reveals something far deeper, far more human: a journey that shows how success isn't an explosion, but an accumulation. A slow, steady build that starts with a few flakes of snow at the top of a cold Omaha hill. Before he became the Oracle of Omaha, Buffett was a socially awkward kid obsessed with numbers. While other children played baseball, Warren was running paper routes, flipping pinball machines, and devouring every investing book he could find. He wasn't gifted with natural charisma. He wasn't born into power. What he did have was a mind wired for long-term thinking and an almost spiritual belief that time is the most powerful force in the universe. But here's where the story gets real. Buffett's path wasn't perfect. The snowball pulls back the curtain on the personal battles he fought: his complicated marriage, his emotional blind spots, and the sacrifices he made chasing financial mastery. The book shows a man who could understand the stock market better than he understood the people closest to him. And it's in those cracks, those flaws, that his story becomes truly compelling. This isn't just a biography. It's a blueprint for anyone who wants to build wealth the Buffett way: slow, steady, and unstoppable. It reveals how he learned to ignore the noise, trust his own scorecard, buy businesses not tickers, and stay calm when the world panicked. It shows how he used temperament, not genius, to outperform entire markets. And it explains why Buffett believes that your greatest asset isn't the money you invest, but the character you build. Because the snowball isn't just a metaphor for compounding money, it's a metaphor for compounding life. Your habits, your choices, the people you surround yourself with, they all stack up, bit by bit, day by day, and over time, they create momentum no one can stop. So if you've ever wondered how ordinary decisions turn into extraordinary results, if you've ever felt behind, late, or overwhelmed, or if you simply want to understand how one man quietly rewrote the rules of wealth and life, stay with this video. Because Warren Buffett's story isn't just worth hearing. It might just change the way you measure success, make decisions, and build a future that compounds long after you're gone. Chapter 1 opens with Warren Buffett at the height of his career, already recognized as one of the most successful investors in the world. Instead of starting from childhood, the book introduces him as a mature figure operating at the center of an extraordinary financial environment, a period where markets are soaring, optimism is high, and many investors believe wealth can be created quickly. This atmosphere is what the book refers to as the bubble, and it establishes the contrast between Buffett's disciplined philosophy and the speculative behavior around him. The chapter highlights Buffett's presence at major business gatherings, shareholder meetings, and media appearances where he is treated with a level of respect usually reserved for heads of state. Yet Buffett remains grounded, consistent in his habits, and unchanged by fame. The author uses this moment in time to illustrate how Buffett's reputation was built, not through trends or fashionable strategies, but through decades of applying the same rational approach to money: buying what he understands, staying patient, and letting compounding do its work. The chapter also shows how people often look to Buffett during periods of market frenzy, expecting him to provide clarity when the financial world becomes noisy. His steady mindset stands in sharp contrast to the speculation and risk-taking that dominate bubble periods. Instead of chasing quick profits, Buffett reminds investors that fundamentals don't change just because excitement rises. Chapter 1 sets the stage for the rest of the biography by presenting Buffett's life philosophy in action: temperament over emotion, long-term thinking over short-term gains, and personal principles over public pressure. It introduces him not only as a billionaire investor, but as someone who built success by resisting the very bubbles that tempted everyone else. Chapter 2 steps back from the opening scene of Warren Buffett as a global investing icon and returns to his early childhood in Omaha. The chapter focuses on the environment that shaped his mindset, a Midwestern household during the Great Depression, where financial insecurity was common and frugality was a way of life. Warren's father, Howard Buffett, is introduced as a central influence and ethical, soft-spoken stockbroker who later became a U.S. congressman. His mother, Leela, is portrayed as strict, demanding, and sometimes emotionally unpredictable, creating a home dynamic that pushed Warren to seek comfort in numbers, books, and solitary pursuits. The chapter highlights Warren's early fascination with money and business. Even as a young child, he showed unusual curiosity about how value is created and how transactions work. He memorized numbers easily, tracked baseball statistics, and read anything quantitative he could find. This intellectual pattern becomes a key foundation for his future approach to investing. Chapter 2 also stresses how Warren developed independent thinking at a young age. While many kids his age focused on school activities, Warren was already experimenting with small ways to earn money, studying prices, analyzing patterns, and observing how people behaved around markets. The book uses these early traits to foreshadow the investor he would become, someone who relies on logic over emotion, who prefers evidence over trends, and who builds decisions from data rather than social pressure. Finally, the chapter emphasizes the contrast between Warren's introverted personality and the expectations of traditional childhood. He didn't fit the mold of a social or athletic child. Instead, he found identity in learning, calculating, and understanding how the world worked through numbers. This chapter positions his early life not as a dramatic story, but as the groundwork for a lifetime of analytical thinking and disciplined decision-making. Chapter 3 continues examining Warren Buffett's early years, focusing on how his interest in business evolved into active money-making experiments. The chapter describes Warren as a child who didn't just enjoy numbers. He used them to understand how profit worked. He tracked prices, studied patterns, and observed how small differences in cost and demand created opportunities. This analytical habit led him to his first practical ventures. One of Buffett's earliest business activities involved buying 6 packs of Coca-Cola and reselling the individual bottles for a margin. He tested similar ideas with gum, magazines, and golf balls. These activities were simple, but the chapter emphasizes how they allowed Warren to learn key business concepts, unit economics, customer behavior, and the value of reinvesting profits. He began to understand that money could grow if managed systematically. The chapter also highlights Warren's habit of collecting discarded golf balls from courses near his neighborhood. After cleaning and sorting them, he sold them at higher prices to local golfers. This wasn't just a childhood hustle. It reflected an emerging investment mindset: acquire undervalued assets, add work or insight, and convert them into something that produces returns. Another focus of Chapter 3 is Warren's early exposure to financial books. He discovered titles on the stock market in his father's brokerage office and became intrigued by the idea that businesses were essentially machines that produced earnings over time. Even before adolescence, he was studying stock tables, learning terminology, and absorbing the logic behind investing. The chapter closes by reinforcing that Warren's early experiences were not random childhood adventures. Instead, they show a consistent pattern of intellectual curiosity, practical experimentation, and a growing understanding of value. These habits form the early structure of Buffett's lifelong approach to business and investing: observe, calculate, act conservatively, and reinvest results. Chapter 4 focuses on Warren Buffett's development as a young entrepreneur and the expansion of his early efforts into more structured money-making activities. The chapter shows how Warren, still in grade school, began viewing every environment as an economic system that could be studied and optimized. He wasn't simply trying to earn pocket money. He was building a framework for analyzing opportunities, measuring risk, and maximizing return. One key episode covered in this chapter is Warren's experience with newspaper routes. Delivering newspapers may seem ordinary, but Buffett approached it with operational discipline. He managed multiple routes simultaneously, tracked customer habits, and organize his delivery process for efficiency. The chapter uses this example to highlight how Warren learned critical skills: handling recurring revenue, managing accounts receivable, and understanding the importance of reliability in business relationships. Chapter 4 also discusses Buffett's growing comfort with financial data. He spent increasing amounts of time in his father's brokerage office, reading stock tables and observing how investors reacted to market changes. Although still very young, he was absorbing ideas about valuation, price movements, and the psychological influence of markets. These experiences strengthened his preference for rational analysis over speculation. Another theme in this chapter is Warren's early recognition of scale. He realized that small daily earnings, when saved and reinvested, could accumulate meaningfully. This idea of compounding still in its early form became a guiding principle in how he evaluated decisions. The chapter emphasizes that Buffett did not yet have a mature investment strategy, but he was already developing the mindset that would define his future: focus on cash flow, minimize waste, and let time do the heavy lifting. Chapter 4 ultimately shows Warren transitioning from curiosity-driven ventures to disciplined business operations. It marks the point where earning money became a structured, repeatable system rather than a series of experiments, setting the foundation for his analytical approach to investing. Chapter 5 describes Warren Buffett's transition from a curious, business-minded child into an adolescent who begins applying structured financial thinking to real investments. The chapter highlights his first serious exposure to the stock market, shaped directly by the environment of his father's brokerage office. Warren observed clients' emotions, listened to market conversations, and studied the price boards. These early exposures deepened his belief that markets were influenced as much by psychology as by fundamentals. A key event in the chapter is Buffett's first stock purchase. At age 11, he bought shares of Citi's Service Preferred for himself and his sister Doris. The stock initially dropped, causing Warren to feel the discomfort of losing money. Eventually, the price rose slightly, and he sold the shares for a small profit. Soon after, the stock climbed far beyond the price he had sold at, leaving him with a clear lesson: impatience and emotional decision-making can undermine long-term gains. This moment becomes a defining early experience, teaching him the importance of holding quality investments rather than reacting to short-term movements. Chapter 5 also explains how Warren continued to study business more deeply. He read financial material beyond his age level, practiced analyzing companies, and began developing a preference for predictable earnings and durable business models. Although still young, he was already thinking like an investor focused on intrinsic value rather than speculation. The chapter additionally notes how Warren's family influences, especially his father's integrity-driven approach to business, shaped his ethical framework. Warren learned to treat money not just as a tool for wealth creation, but as a responsibility requiring discipline and clear judgment. Overall, Chapter 5 marks Warren's first real contact with market risk, emotional volatility, and the rewards of patience. It shows him moving from entrepreneurial activities into true investing, building foundational habits that would guide his future decisions. Chapter 6 focuses on Warren Buffett's early teenage years, a period when his interest in business evolved into a more systematic pursuit of financial knowledge. The chapter explains how Warren began studying markets and economic trends with increasing seriousness, using every available resource from library books to observing real brokerage activity to build a foundation for long-term investing. A major theme in this chapter is Warren's development of disciplined saving habits. By age 13, he had accumulated a notable amount of money from newspaper routes and small ventures. Instead of spending it, he tracked his income and expenses meticulously, even filing his first tax return, which reflected his unusually organized financial behavior for someone his age. This emphasis on record-keeping demonstrates the early appearance of Buffett's commitment to operational clarity and accountability. The chapter also highlights Warren's purchase of a 40-acre farm with a partner. Although he was too young to operate it himself, he hired a tenant farmer to manage the land. This experience represents Buffett's first exposure to passive income and asset-based earnings, earning money from a productive asset rather than personal labor. It reinforces his belief that capital, when deployed intelligently, can work independently of time and effort. Chapter 6 further explores Warren's growing independence in decision-making. He became critical of emotional or speculative behavior and preferred choices that were supported by clear logic and long-term benefit. These traits were visible not only in his financial activities, but also in his academic preferences, where he gravitated toward math, probability, and subjects that rewarded analytical thinking. Overall, Chapter 6 illustrates a critical developmental phase. Warren transitions from a young entrepreneur, experimenting with money, into a teenager building real financial systems. His early investments, disciplined savings, and analytical approach form the structural mindset that will shape his adult investing. Principles: rationality, compounding, and asset-based income. Chapter 7 examines Warren Buffett's progression through high school and how the stage solidified his identity as someone unusually focused on money, numbers, and independent thinking. The chapter shows that while most students were occupied with social life and typical teenage activities, Warren remained committed to scaling his income and expanding his financial knowledge. One key element in this chapter is Warren's growing proficiency in evaluating business opportunities. He continued managing newspaper routes with a structured system, emphasizing efficiency and predictable cash flow. His disciplined approach allowed him to accumulate several $1,000s. By the time he was a teenager, a substantial amount for the era. The book highlights this not as a result of luck, but of repeated, systematic behaviors. The chapter also explores Warren's experience working in his grandfather's grocery store. While he disliked the work, it provided early insight into low-margin businesses and the operational challenges of retail. This helped shape his later preference for companies with strong economics, durable competitive advantages, and pricing power. Another major point in Chapter 7 is Warren's deepening interest in studying successful entrepreneurs. He read extensively about business leaders and investors, analyzing how they made strategic decisions. This habit reinforced the importance of long-term planning and rational judgment, further distancing him from impulsive or trend-driven thinking. Academically, Warren excelled in math, but showed limited interest in subjects outside his focus. The chapter notes that he was intelligent, but not academically broad. His strengths were concentrated in quantitative analysis and logical reasoning. A final theme is Warren's growing desire for independence. He began imagining a future built around financial freedom and self-directed work rather than traditional employment. This mindset, turning from assets, controlling time, and avoiding dependence, becomes a cornerstone of his long-term philosophy. Chapter 7 ultimately shows a teenager already functioning with the mindset of an investor, analytical, opportunity-driven, and committed to compounding his efforts over time. Chapter 8 covers Warren Buffett's transition from high school into early adulthood, focusing on his decision-making process around education, work, and long-term career direction. At this stage, Warren had already accumulated more money than many adults around him, but he was still searching for a clear understanding of what path would best leverage his skills and interests. The chapter highlights Warren's initial reluctance toward traditional college education. He considered it inefficient compared to real business activity and felt he could learn more by working directly with markets and studying companies on his own. However, pressure from his family, especially his father, ultimately led him to enroll at the Wharton School at the University of Pennsylvania. The book makes it clear that Warren respected his father deeply, and this relationship played a significant role in guiding decisions he might not have made independently. At Wharton, Warren was academically capable but unimpressed by much of the curriculum. He believed many professors focused on theory rather than practical investing principles. This disconnect reinforced his preference for hands-on learning and evidence-based thinking. He spent more time reading outside material and analyzing companies than engaging with traditional coursework. Chapter 8 also emphasizes Warren's ongoing drive to build wealth systematically. Even while managing school responsibilities, he continued operating small ventures, studying financial statements, and observing market behavior. He remained committed to the idea that economic understanding comes from real numbers and real businesses, not abstract academic frameworks. Another important component of this chapter is Warren's social adjustment. He was still introverted, uncomfortable in typical college interactions, and far more engaged by business problems than social activities. The chapter uses these observations to show that Warren's strengths were heavily concentrated: discipline, analysis, and long-term focus. Overall, Chapter 8 captures a transitional period where Warren begins merging academic exposure with self-directed financial learning, setting the stage for the mentors and ideas that will shape his investing philosophy. Chapter 9 focuses on Warren Buffett's continued dissatisfaction with his experience at the Wharton School and the eventual decision that leads him to transfer back to Nebraska. The chapter highlights how Warren's practical, data-driven mindset conflicted with the academic structure he encountered. Many of his courses emphasized broad economic theory rather than the concrete business analysis he believed mattered most. This reinforced Warren's belief that real investing skill comes from studying companies directly, not from abstract models. Despite his skepticism toward formal education, Warren maintained strong academic performance. However, he found himself disengaged from both the curriculum and the social environment. His introverted nature and intense focus on business activity made college life feel inefficient. This internal conflict eventually pushed him to persuade his family, especially his father, that returning to Omaha would allow him to learn in a way that aligned better with his strengths. After transferring to the University of Nebraska, Warren accelerated his coursework, completing his degree quickly while continuing to pursue independent study. He spent extensive time analyzing financial statements, reading investment literature, and exploring market patterns. This period reinforced his preference for self-directed learning and exposed him to a wider range of business opportunities in his home community. Chapter 9 also introduces the early seeds of Warren's future investment philosophy. He recognized that disciplined research, consistent study, and rational evaluation created advantages that most investors ignored. Although he lacked a mentor like Benjamin Graham at this stage, his thinking was already moving toward the concepts that would later define value investing. Overall, Chapter 9 documents Warren's strategic decision to break away from an educational path that did not match his professional goals. It marks an early example of his willingness to make unconventional choices when he believed they offered better long-term outcomes. Chapter 10 focuses on the pivotal period when Warren Buffett discovers Benjamin Graham's ideas and begins aligning his investing mindset with a formal, structured framework. This chapter represents a bridge between Warren's self-taught financial habits and the disciplined value investing philosophy that would ultimately define his career. The chapter explains that after returning to Omaha and completing his degree at the University of Nebraska, Warren explored options for graduate education not out of academic enthusiasm, but because he wanted targeted knowledge that would improve his investing ability. During his research, he encountered Graham's classic book, The Intelligent Investor. The book had a profound impact on him. For the first time, Warren found an approach that matched his natural instincts, buying undervalued companies, focusing on intrinsic value, and using logic instead of emotion to make decisions. Warren discovered that Graham was teaching at Columbia Business School, which immediately shifted his academic plans. Despite earlier skepticism about formal education, Warren applied specifically because he wanted to study directly under Graham. This decision was driven by strategic intent rather than traditional academic motivation. Chapter 10 also describes Warren's excitement as he immersed himself in Graham's writing. He studied the concepts of margin of safety, market irrationality, and the distinction between price and value. These ideas helped clarify patterns he had already observed through his early investing experiences, but had not yet articulated clearly. The chapter highlights another important factor: Warren's growing willingness to seek mentorship. Up to this point, most of his learning had been self-directed. Discovering Graham marked a shift towards structured guidance, signaling Warren's understanding that expertise could accelerate his progress. Overall, Chapter 10 shows Warren at a turning point, transitioning from an independent but unrefined investor into a student actively pursuing a disciplined, evidence-based investment philosophy. It sets the foundation for the transformative relationship with Graham that follows. Chapter 11 covers Warren Buffett's entrance into Columbia Business School, where his long-anticipated opportunity to study directly under Benjamin Graham finally becomes reality. The chapter highlights how this environment immediately changes Warren's academic engagement. Unlike his earlier experiences at Wharton, Warren finds Columbia's curriculum, specifically Graham's course on security analysis, deeply aligned with his own thinking. The classroom becomes a place where theory and practice meet in a way that directly supports his investing goals. The chapter explains how Warren immersed himself in Graham's teachings. Concepts such as intrinsic value, margin of safety, and market inefficiency were no longer abstract ideas. They were practical tools he could apply while analyzing real companies. Warren embraced the idea that the stock market is often driven by emotion, causing prices to deviate from underlying business value. This reinforced his belief that disciplined, rational analysis creates opportunities for long-term outperformance. Another key figure introduced in this chapter is David Dodd, Graham's co-author. Warren respected Dodd's methodical approach and appreciated how both professors emphasized rigorous accounting-based valuation. Their combined influence had a foundational impact on Warren's developing investment strategy. Chapter 11 also discusses Warren's personal approach to learning at Columbia. Unlike earlier stages of his education, he became an active participant, tasking questions, engaging deeply with case studies, and analyzing businesses far beyond the course requirements. He viewed every class as a direct investment in his future capabilities. A notable point in this chapter is Warren's realization that value investing was not widely adopted. Despite its logical structure, this recognition later becomes one of Warren's key advantages: the ability to apply a rational, patient strategy in a market dominated by short-term thinking. Overall, Chapter 11 marks the formal beginning of Warren's transformation into a true value investor. It shows how structured mentorship and academic rigor helped refine instincts he had developed since childhood, giving him a clear, enduring framework for evaluating businesses. Chapter 12 focuses on Warren Buffett's deepening relationship with Benjamin Graham's investment philosophy and the early interactions that shaped his professional identity. By this point at Columbia, Warren is not just a student absorbing information, he is actively applying Graham's principles to real companies, testing valuation methods, and sharpening his understanding of intrinsic value. The chapter emphasizes how Graham's disciplined approach gave Warren a systematic way to think about risk, pricing, and opportunity. One of the key themes in this chapter is Warren's growing admiration for Graham, both intellectually and personally. Warren viewed Graham not only as a professor but as a model for how rational investing could be practiced with integrity and consistency. The chapter notes that Warren considered Graham the smartest man he had ever met, and this respect drove him to master the material at a deeper level than typical coursework required. Chapter 12 also details Warren's ongoing search for undervalued stocks, cigar butts. In Graham's terminology, Warren identified companies that were priced below their working capital or trading at unusually low multiples based on liquidation value. This hands-on activity reinforced the idea that thorough research and unemotional analysis could uncover opportunities overlooked by the broader market. Another central point in the chapter is Warren's attempt to join Graham Newman, Graham's investment partnership. Although Warren was eager, the firm was not hiring at the time. This rejection becomes a meaningful moment in the narrative, not because Warren accepted it permanently, but because it demonstrated his willingness to pursue opportunities persistently. The chapter concludes with Warren firmly committed to value investing as a lifelong framework. He had not yet refined it into the more qualitative style he would later adopt, but the foundation was set: disciplined buying, careful analysis, and reliance on data over emotion. Chapter 13 covers the period when Warren Buffett completes his studies at Columbia and enters the professional world with a strong commitment to Benjamin Graham's investment philosophy. The chapter emphasizes that although Warren now possessed a clear framework for investing, he still needed an opportunity to apply it at scale. His first goal was to work for Graham Newman, the the investment firm run by his mentor. Despite Warren's persistence, the firm initially declined to hire him, citing limited openings and the firm's preference for candidates from New York. With Graham Newman unavailable, Warren returned to Omaha and began exploring independent opportunities. The chapter explains that this phase was not simply a fallback. It became an important training ground. Warren started teaching a night class on investing at the University of Nebraska. Although he was only in his early 20s, he felt confident in explaining Graham's methods, including intrinsic value, margin of safety, and how to assess undervalued companies. Teaching reinforced his understanding and helped refine the way he communicated financial concepts, an early hint of the clarity that would later be seen in Berkshire Hathaway shareholder letters. The chapter also describes Warren's early experiences working as a stockbroker. He disliked the role because the business model depended on generating commissions rather than providing rational, long-term advice. He saw firsthand how brokers often encouraged clients to trade frequently, driven by emotion rather than analysis. This environment strengthened Warren's conviction that genuine investing required patience, discipline, and independence from market noise. Another key aspect of Chapter 13 is Warren's growing confidence in running his own money. He continued researching small, undervalued companies and investing modest sums using Graham's cigar-butt principles. Although the scale was small, the process demonstrated that his analytical approach could produce repeatable returns. Overall, Chapter 13 marks Warren's transition from academic mastery to real-world application, setting the stage for his eventual breakthrough in joining Graham Newman and launching his first investment partnerships. Chapter 14 centers on Warren Buffett's persistence and eventual success in joining the Graham Newman Corporation, the investment partnership run by Benjamin Graham. This chapter represents a major turning point. Warren finally secures the opportunity to work directly under the person who shaped his investing philosophy. The chapter explains that Warren continued sending letters to Graham after returning to Omaha. He shared investment ideas, asked technical questions, and demonstrated strong knowledge of Graham's principles. While Graham initially rejected Warren's job applications, a change in circumstances eventually created an opening, and Warren was invited to join the firm in New York. This represented the fulfillment of Warren's long-standing goal. At Graham Newman, Warren worked as a securities analyst. The chapter emphasizes that his responsibilities were not glamorous. Much of the work involved detailed examination of obscure, undervalued companies and special situation opportunities. These tasks aligned perfectly with Warren's analytical strengths and Graham's value investing method. Warren embraced the rigorous environment and learned how to apply Graham's ideas with professional depth and structure. Chapter 14 highlights several of the technical skills Warren developed during this period, including identifying liquidation values, assessing balance sheet strength, evaluating arbitrage opportunities, and analyzing companies trading below intrinsic value due to temporary mispricing. He also observed firsthand how Graham enforced discipline, buying only when conditions met strict criteria, and avoiding emotional or speculative decision-making. The chapter points out that while Warren fully adopted Graham's methods, he also began noticing their limitations. Many of the cigar-butt companies he analyzed were cheap but offered little long-term potential. This early observation would later influence Warren's shift toward a more qualitative approach. Overall, Chapter 14 marks Warren's transition from a student of value investing to a practitioner operating inside one of the most disciplined investment organizations of the era. It provided practical experience, mentorship, and a professional foundation that shaped his early career and prepared him for launching his own partnerships in the years that followed. Chapter 15 focuses on Warren Buffett's day-to-day work inside the Graham Newman Corporation and how this experience refined his analytical discipline. While Warren had already mastered the theory of value investing at Columbia, this chapter shows how working in Graham's firm exposed him to the practical, methodical routines that shaped his early professional habits. The chapter explains that Graham Newman operated with strict investment rules, focus on quantitative undervaluation, avoid emotional judgments, and construct portfolios from many small, deeply discounted positions. Warren's responsibilities involved screening balance sheets, reviewing special situations, and identifying companies trading below liquidation value. The work was repetitive and detail-heavy, but ideal for Warren's temperament. He learned how to evaluate assets conservatively, test assumptions rigorously, and document investment cases with precision. Chapter 15 also describes the professional culture at the firm. Graham and Dodd emphasized discipline over intuition. Every idea required numerical justification, and decisions were reviewed through a rational, rule-based lens. This environment reinforced Warren's natural preference for logic, but it also showed him how an investment process could be organized systematically. He observed that consistency, not brilliance, was the key to long-term results. Another important point in this chapter is Warren's realization that many of Graham's cigar-butt investments were statistically attractive, but operationally weak companies. Although they met the quantitative criteria, they lacked durable business quality. Warren started to see that businesses should be evaluated not only on price, but also on long-term earning power. This observation planted the early seeds of his later shift toward buying wonderful businesses at fair prices. The chapter also mentions Warren's continued admiration for Graham, not just as an investor, but as an ethical and thoughtful leader. Graham's balanced life, intellectual curiosity, and fairness made a lasting impression on Warren's worldview. Overall, Chapter 15 captures Warren's evolution from a theoretical value investor into a disciplined practitioner. It marks a phase where rigorous analysis, professional structure, and exposure to real investment operations sharpened the foundation he would later build upon. In his own partnerships, Chapter 16 focuses on Warren Buffett's final months at the Graham-Newman Corporation and the transition that follows after Benjamin Graham retires and winds down the firm. This chapter represents a major turning point in Warren's early career. He must decide how to apply the disciplined value investing framework he has learned, without the structure of Graham's organization supporting him. The chapter explains that Graham's decision to close the partnership was motivated by personal priorities and a desire to step back from professional responsibilities. For Warren, this meant the end of his most influential mentorship and the loss of a workplace that fully aligned with his analytical style. Despite this, Graham encouraged Warren to continue developing his own investing path and expressed confidence in his abilities. During this period, Warren faced several options: stay in New York and work for another investment firm, become a full-time stockbroker again, or return to Omaha to pursue independent investing. The chapter emphasizes that Warren's preference for autonomy and his long-standing desire to run his own capital guided his thinking. He recognized that working under environments driven by commissions or speculation would limit his ability to follow a disciplined value investing strategy. Chapter 16 also highlights Warren's evolving perspective on investment quality. While he remained committed to Graham's principles, he had begun to recognize that buying only statistically cheap stocks had limitations. He was increasingly aware that some businesses were able to generate higher long-term returns because of their competitive advantages, not just their low price. This shift in thinking was still early, but it signaled the development of a more qualitative dimension to his approach. The chapter concludes with Warren returning to Omaha, ready to build an investment practice rooted in everything he learned from Graham, but adapted to his own judgment. This decision sets the stage for the creation of his first investment partnerships, where his independent strategy would fully emerge. Chapter 17 describes Warren Buffett's return to Omaha after leaving the Graham-Newman firm, and the early foundation of what would eventually become his investment partnership empire. This chapter focuses on how Warren, now in his mid-20s, begins applying Graham's principles independently while adapting them to real-world conditions. Outside the structured environment of New York, the chapter explains that Warren arrived back in Omaha with a small amount of personal capital, deep confidence in the value investing framework, and a clear desire to operate autonomously. Rather than joining an existing firm or brokerage, he spent time analyzing potential investments, studying company reports, and building relationships with people who might eventually become limited partners. This was the phase where Warren began shifting from being an employee to becoming an investment manager. A key element highlighted in Chapter 17 is Warren's growing understanding of how to work with family and friends as potential investors. He recognized that successful investment management required not only good analysis, but also clear communication and trust. Warren did not want to promote speculation or unrealistic expectations. Instead, he emphasized a disciplined, long-term approach aligned with Graham's philosophy. This cautious, transparent communication style became one of his defining traits as a manager. The chapter also details Warren's early investment activities during this time. He continued to focus on undervalued securities, but opportunities where statistical mispricing created potential upside with limited downside risk. He analyzed small, obscure companies that larger institutions ignored, using the same strict criteria he learned from Graham. Another important point in this chapter is Warren's increasing independence in refining his investment strategy. Although Graham remained the intellectual foundation, Warren started recognizing that some businesses with stronger economics could offer superior long-term returns even if they weren't cheap in the strict Graham sense. Overall, Chapter 17 captures the transitional stage where Warren moves from student and employee to independent thinker, preparing to launch his first partnerships, setting the stage for his rapid ascent in the investing world. Chapter 18 focuses on the period when Warren Buffett begins forming the structure and philosophy of his first investment partnerships. After returning to Omaha and operating independently for a short time, Warren recognizes that managing outside capital will allow him to scale his investment approach, increase his opportunities, and build a more stable long-term career. The chapter shows how he approaches this step methodically, using lessons from Graham while adapting them to his own communication style and operational preferences. The chapter explains that Warren carefully selected potential partners from among family, friends, and acquaintances. He prioritized individuals who trusted him, understood his conservative approach, and were willing to allow him full discretion without emotional interference. Warren drafted clear partnership agreements that emphasized long-term horizons, strict value-based decision-making, and protections for partners in the form of performance-based compensation. These documents became the template for his future partnerships. A significant portion of the chapter highlights Warren's emphasis on managing expectations. He made it clear that he would not follow market trends, attempt to forecast economic cycles, or chase popular stocks. Instead, he focused on undervalued opportunities where he could calculate intrinsic value with confidence. Warren structured the partnership so his own compensation depended on outperforming a defined hurdle rate, aligning his incentives with those of the partners. Chapter 18 also discusses Warren's early investment strategies within the partnership framework. He continued identifying but stocks, special situations, and arbitrage opportunities. The limited size of the early partnership allowed him to pursue investments too small or too illiquid for larger institutions, giving him a meaningful advantage. Finally, the chapter highlights the discipline and clarity Warren brought to communication. His early letters to partners were straightforward, analytical, and focused on principles rather than predictions. This transparency became a cornerstone of his long-term reputation. Overall, Chapter 18 marks the formal launch of Warren's professional investing career, where structure, process, and disciplined value analysis converge into his first true business operation. Chapter 19 focuses on Warren Buffett's early years as a partnership manager and how he transformed a small pool of capital into a disciplined investment operation. By this stage, Warren has formally launched his first partnership and is beginning to implement the systematic investment strategy that would define his long-term success. The chapter explains that Warren operated his partnerships with a clear structure. He invested alongside his partners, took no management fee, and earned a performance fee only after exceeding a defined benchmark. This alignment of incentives created immediate trust and set him apart from typical investment managers of the time. Warren emphasized transparency, long-term thinking, and a calm, rational approach, values rooted in Graham's philosophy but adapted to Warren's own style. Chapter 19 highlights Warren's early investment environment in Omaha. Working from modest offices, he relied on meticulous research rather than Wall Street connections. He reviewed balance sheets, annual reports, and stock tables constantly, searching for mispriced securities. His strategy focused on three categories: undervalued cigar butt stocks, special situations including arbitrage and restructurings, and higher quality businesses available at reasonable prices. Although his emphasis still leaned toward Graham's pure value techniques, Warren was slowly expanding his toolkit. The chapter also explores Warren's relationship with his partners. He maintained regular communication through detailed letters explaining his methods, performance results, and long-term objectives. These letters avoided predictions or commentary on market conditions. Instead, Warren focused on explaining the logic behind decisions and the importance of staying patient during market volatility. A key point illustrated in Chapter 19 is Warren's growing confidence. His early results were strong, reinforcing his belief in disciplined value investing. At the same time, he remained cautious, reinvesting gains conservatively and avoiding overconfidence consistent with the margin of safety principle. Overall, Chapter 19 shows Warren transitioning from a promising young investor into a competent, organized fund manager, building a record of consistent performance through rational analysis and rigorous discipline. Chapter 20 focuses on the expansion phase of Warren Buffett's investment partnerships, as he begins managing a growing pool of capital and earning the confidence of an increasing number of limited partners. By this point, Warren has established a consistent track record, and the chapter describes how his disciplined approach begins to attract more attention, not through promotion, but through results. The chapter explains how Warren continued operating multiple small partnerships simultaneously, each structured identically but comprising different groups of investors. Rather than combining them into a single fund, he maintained separate entities to accommodate personal relationships and differences in partner circumstances. This structure allowed him to maintain flexibility while ensuring that all investors operated under the same clear rules and incentives. Warren's investment strategy during this period remained grounded in Graham's principles, but he increasingly applied a more refined version of value analysis. He identified opportunities in obscure companies, thinly traded stocks, and special situations that larger institutions could not efficiently pursue. The chapter highlights his use of workouts, short-term mispricings involving mergers, liquidations, or reorganizations, as well as undervalued equities trading at deep discounts to intrinsic value. These strategies reduced correlation with general market movements and allowed Warren to produce returns independent of market cycles. Chapter 20 also describes the operational discipline Warren brought to partnership management. He maintained precise accounting records, monitored performance across all partnerships, and reinvested his own share of profits alongside his partners. His communication style remained consistent, objective, principle-based, and free from speculative commentary. A key insight in this chapter is Warren's recognition that scale brings both opportunities and constraints. As assets grew, he became more selective, aware that larger positions required deeper conviction and more durable business characteristics. Overall, Chapter 20 captures a period of steady expansion where Warren's discipline framework, analytical rigor, and conservative structure begin compounding into early professional momentum. Chapter 21 examines the period when Warren Buffett's partnerships begin to generate returns strong enough to draw both admiration and skepticism from the broader investing community. While his results are impressive, Warren remains focused on process rather than recognition. The chapter emphasizes how his disciplined approach contrasts sharply with the speculative enthusiasm appearing in the markets during this period. A central theme is Warren's increasing use of special situations and workout short-term opportunities created by corporate actions such as mergers, tender offers, and liquidations. These investments provided predictable, low-risk returns when executed correctly, and they allowed Warren to maintain performance consistency even when general market conditions fluctuated. The chapter highlights his ability to manage many such opportunities simultaneously, demonstrating his growing capacity to run an expanding portfolio. The chapter also describes the environment surrounding Warren's partnerships. As his reputation spread, more acquaintances approached him with capital. Despite rising interest, Warren continued to be selective, accepting new partners only when he believed it would not compromise his investment flexibility. He maintained the same incentive structure and communication standards, reinforcing the idea that alignment and discipline were more important than rapid growth. Additionally, Chapter 21 explains Warren's increasing recognition of the psychological component of investing. He observed that most investors were driven by emotion, trend following, or speculation. This reinforced his commitment to rational decision-making and further convinced him that value investing could outperform, simply because so few people were willing to apply it consistently. Another key point in the chapter is Warren's emphasis on staying within his circle of competence. He avoided industries he didn't fully understand and focused on companies with financial statements he could evaluate with high confidence. This selective approach helped him maintain a strong performance record without taking unnecessary risks. Overall, Chapter 21 illustrates Warren's continued evolution as a disciplined capital allocator, scaling his partnerships, refining his strategy, and strengthening the behavioral principles that would define his long-term success. Chapter 22 focuses on Warren Buffett's early interaction with the insurance industry and how this exposure begins shaping one of the most important structural elements of his long-term investment model, the use of insurance float. Although Warren does not yet control a major insurance company in this period, the chapter highlights his growing appreciation for the economics behind the business and the strategic advantages it can offer an investor with disciplined judgment. The chapter explains that Warren studied insurance operations in detail, how premiums are collected upfront, how claims are paid later, and how the capital held in the interim, the float, can be invested. He recognized that if an insurance operation is run conservatively and underwrites policies with discipline, the float essentially acts as a low-cost or even negative-cost source of investment capital. This idea aligned naturally with Warren's value-driven approach, offering leverage without traditional financial risk. In parallel, the chapter describes Warren's expanding investment activities as his partnerships continue to grow. He looks for ways to deploy increasing amounts of capital while maintaining strict standards. Insurance companies, with their predictable cash flow and regulated reporting, become appealing opportunities for analysis. Warren realizes that strong management and responsible underwriting are key differentiators in this sector. Another theme in Chapter 22 is Warren's shift toward recognizing the importance of business quality, not just statistical cheapness. While he still employs Graham-style strategies, he is increasingly studying companies with durable economics and recurring cash flows. Insurance represents one of the first major industries where he sees the potential for compounding. On a much larger scale, the chapter also highlights Warren's continued discipline in communication with partners. Even as opportunities grow, he maintains conservative expectations and emphasizes that expansion will not alter the principles guiding his decisions. Chapter 22 introduces the early foundation of one of Buffett's most powerful long-term tools, insurance float, and demonstrates his widening perspective on businesses capable of sustaining compounding returns. Chapter 23 focuses on the period when Warren Buffett's investment partnerships continued to grow in both size and complexity, leading him to increasingly seek scalable opportunities that match his expanding pool of capital. The chapter highlights how Warren begins shifting from small cigar-butt investments toward situations that offer more meaningful impact on overall performance. A central theme in this chapter is Warren's early encounter with Geico, the insurance company that would later become one of the most influential investments of his career. Warren initially learned about Geico through Benjamin Graham, who served as the company's chairman. Motivated by curiosity and a desire to understand a Graham-endorsed business firsthand, Warren traveled to Washington, D.C., where he met Lorimer Davy Davidson, a senior Geico executive. This meeting becomes a crucial learning experience. Davidson generously spent hours explaining GEICO's business model, distribution structure, underwriting discipline, and cost advantages. Warren realized that Geico possessed characteristics rare among the companies he typically analyzed. A durable competitive advantage, a clear market focus, and strong long-term economics. The company's direct-to-consumer model gave it a structural cost advantage over traditional insurers, allowing it to price policies more competitively while maintaining strong underwriting performance. Chapter 23 emphasizes that this experience reshaped Warren's thinking. He recognized that buying exceptional businesses at fair prices could generate greater long-term returns than purchasing merely cheap stocks with limited prospects. Geico became one of the first companies to demonstrate to Warren the power of compounding within high-quality business models. The chapter also notes that Warren invested a significant portion of his personal savings into Geico, showing strong conviction based on his analysis rather than speculation. This reflected a meaningful evolution in his investment philosophy. Overall, Chapter 23 marks a turning point. Warren transitions from strictly Graham-style quantitative investing toward a hybrid approach that values business quality, competitive advantages, and long-term economics concepts that would later define Berkshire Hathaway's core strategy. Chapter 24 examines the consolidation phase of Warren Buffett's partnership operations as the assets under his management continue to expand. By this point, Warren's track record is attracting more capital, which forces him to think strategically about scale, opportunity size, and the constraints that come with managing larger sums. The chapter highlights how Warren maintains discipline while adapting his investment approach to the partnership's growing footprint. A key focus of Chapter 24 is Warren's increasing emphasis on concentration in higher quality opportunities. While he still used Graham-style cigar butt investing where appropriate, the rising capital base made very small, illiquid opportunities less impactful. Warren began gravitating toward situations where he could deploy more meaningful amounts of capital without compromising returns. This shift reflects his ongoing transition from a purely quantitative investor to one who also considers business durability and long-term economic strength. The chapter also discusses Warren's operational discipline as a partnership manager. He maintained several separate partnerships but ran them uniformly, ensuring identical rules, fee structures, and performance benchmarks. This consistency helped strengthen partner confidence and reinforced his reputation for fairness and transparency. Chapter 24 highlights how Warren approached market volatility during this period. Rather than reacting to short-term movements, he viewed declining markets as sources of opportunity. His letters to partners emphasized that temporary price declines were not risks, but potential entry points. An application of Graham's philosophy of focusing on intrinsic value rather than market sentiment. Another important aspect of this chapter is Warren's investment environment in Omaha. Operating outside Wall Street allowed him to avoid the noise and herd behavior that influenced many other investors. His geographic independence reinforced his analytical independence, giving him a behavioral advantage. Overall, Chapter 24 shows Warren managing the growing complexity of his partnerships while staying rooted in disciplined value investing. It marks a phase where he balances scale with selectivity, adapts to a larger capital base, and strengthens the structural foundation that will support his future investment decisions. Chapter 25 focuses on the period when Warren Buffett's partnership operations continue to strengthen, and his investing approach becomes more structured, confident, and scalable. By this stage, Warren has built an outstanding performance record, and his capital base is growing rapidly. The chapter emphasizes how he refines his investment discipline while identifying opportunities that match the increasingly larger amounts of money he must deploy. One of the major themes in this chapter is Warren's continued search for mispriced securities and special situations, but with greater selectivity. He realizes that as his partnerships expand, the smallest undervalued stocks no longer move the needle. As a result, Warren becomes more focused on businesses or opportunities where he can allocate larger sums without sacrificing safety or expected return. This shift marks another step in his evolution from Graham-style deep value picking toward fewer, higher quality positions. Chapter 25 also highlights the growing distinction in Warren's thinking between price-driven opportunities and business-driven opportunities. While he continues to act on statistical bargains, He increasingly studies companies with strong management, predictable earnings, and competitive advantages. These observations gradually shape his future philosophy of buying wonderful businesses at fair prices. The chapter further explores Warren's disciplined relationship with his partners. He continues sending detailed letters explaining results, investment categories, and expectations. He repeats that the partnership will avoid forecasts, market speculation, and emotional behavior. Warren's communication reinforces trust and strengthens the long-term alignment that defines his partnerships. Another element in this chapter is Warren's personal routine and environment in Omaha. Working away from Wall Street allows him to think independently, avoid noise, and concentrate on data-driven decisions. This geographic separation becomes a structural advantage in his behavioral discipline. Overall, Chapter 25 shows Warren managing larger capital, sharpening his investment framework, and moving closer to the strategy that will later define Berkshire Hathaway. Balancing deep value principles with a growing appreciation for high-quality businesses. Chapter 26 explores Warren Buffett's increasing recognition that business quality, not just statistical cheapness, plays a crucial role in long-term investment performance. This chapter marks an important intellectual shift in Warren's evolution as an investor, reflecting lessons gained from earlier experiences such as Geico, and reinforced by the growing scale of his partnerships. A central theme of the chapter is Warren's gradual movement beyond the pure Graham style cigar butt opportunities. While he continued to use deep value strategies when appropriate, the limitations of buying low-quality businesses became clearer. These companies often required constant monitoring, offered limited competitive advantages, and depended heavily on short-term market conditions. As Warren's capital base expanded, he began searching for opportunities that combined undervaluation with sustainable economics. The chapter highlights how Warren increasingly studied companies with durable competitive advantages, strong management, and predictable long-term earnings. He did not yet fully adopt the qualitative framework that later defined the Berkshire Hathaway era, but the intellectual transition was underway. Warren realized that paying a fair price for a stronger business could produce higher compounded returns than purchasing weak businesses at very low prices. Chapter 26 also explains how Warren's partnership structure matured during this period. With more capital and more partners, Warren refined his process for analyzing and categorizing investments. He became more selective with the size of positions, seeking higher conviction opportunities where he could allocate meaningful amounts of capital. Another important element of the chapter is Warren's disciplined management style. He maintained strict rules regarding communication, risk control, and portfolio construction. His letters to partners during this period emphasized principles rather than predictions, reinforcing consistency and long-term thinking. Overall, Chapter 26 marks a significant step in Warren's strategic evolution. While still grounded in Graham's principles of intrinsic value and margin of safety, Warren was moving toward a broader philosophy, one that recognized the compounding power of high-quality businesses and set the stage for his later transformation into a long-term owner of exceptional companies. Chapter 27 focuses on Warren Buffett's first significant interaction with Berkshire Hathaway, long before it became the conglomerate it is known as today. At this stage, Berkshire is a struggling New England textile mill far from a high-quality business, but it becomes an early example of Warren's willingness to act decisively when he identifies opportunity, even in industries he does not fully favor. The chapter explains that Warren initially approached Berkshire purely as a deep value investment. The company was trading at a price well below its working capital value, making it an attractive target under Graham-style analysis. Berkshire had excess cash, undervalued assets, and appeared to offer a margin of safety. Warren began purchasing shares gradually, viewing the investment as a typical cigar butt opportunity, one last puff of value before the business declined further. However, the chapter highlights that Warren's investment soon became more complicated. He met with Berkshire's management and assessed the company's operations. While the fundamentals confirmed that the textile business was structurally weak, Warren saw an opportunity to influence corporate decisions if he accumulated a controlling interest. This was an early indication of his growing interest in active ownership, not just passive investment. The chapter also describes the tension between value and quality that Berkshire represented. Warren understood the textile industry lacked long-term competitive advantages, but he was attracted to the numerical undervaluation and the potential for smarter capital allocation. This conflict illustrates the transitional phase of Warren's philosophy, still deeply rooted in Graham's methods, but increasingly influenced by his own judgment. Chapter 27 further explains that Warren's purchases of Berkshire shares began shaping his eventual shift toward owning entire businesses, rather than only marketable securities. Although he did not yet foresee Berkshire's future role, the investment provided critical experience in managing real operations. Overall, Chapter 27 captures a pivotal moment: Warren's early involvement with Berkshire Hathaway, blending deep value instincts with the emerging strategic thinking that would later define his career. Chapter 28 examines Warren Buffett's growing involvement with Berkshire Hathaway and the operational and strategic issues he confronted as he continued buying shares of the company. By this point, Warren had accumulated a significant position, large enough to influence corporate decisions, but Berkshire remained a declining textile manufacturer facing competitive pressures and shrinking margins. The chapter explains that Warren initially believed Berkshire's undervalued assets, especially cash reserves, could be profitably redirected into better investment opportunities. However, as he became more engaged with the company, he realized that the textile business was structurally disadvantaged. High labor costs, foreign competition, and capital-intensive operations left little room for sustainable profitability. Yet the stock remained cheap enough, from a pure Graham-style perspective, to justify Warren's continued accumulation. A key theme in Chapter 28 is management conflict. Warren was dissatisfied with certain decisions made by Berkshire's leadership, particularly regarding share repurchases. He believed management was not acting in shareholders' best interests, and that capital was being deployed without discipline. When a disagreement emerged over a proposed tender offer, Warren interpreted the situation as evidence of poor governance. This event pushed him toward taking control of the company outright. The chapter highlights that Warren's decision to acquire control was not driven by enthusiasm for the textile business, but by principles. He disliked being treated unfairly as an investor. His response reflected his long-standing belief in rational, shareholder-oriented management. Another important point is Warren's increasing comfort with operational ownership. Although he had limited interest in textiles, he saw value in gaining control of a corporate platform that could eventually reinvest earnings in more productive assets. Chapter 28 shows Warren transitioning from a passive deep value investor to an active business owner who is willing to take control when management behavior conflicts with rational capital allocation. This chapter sets the stage for Berkshire Hathaway's eventual transformation into his primary investment vehicle. Chapter 29 covers Warren Buffett's full takeover of Berkshire Hathaway and the early operational challenges he faced once he became the controlling shareholder. This chapter marks the moment Berkshire shifts from being merely a deep value investment to becoming the corporate foundation upon which Warren will eventually build his long-term investment platform. The chapter explains that Warren's decision to assume control was driven by principles rather than enthusiasm for the textile industry. After his dispute with Berkshire's existing management regarding a tender offer, Warren believed leadership had acted against shareholder interests. His response was to buy enough stock to ensure that future decisions would be made rationally and with proper governance. This was a defining moment in Warren's development as both an investor and a manager. Once in control, Warren immediately confronted the structural realities of the textile business. The chapter outlines the economic pressures Berkshire faced: foreign competition, shrinking profit margins, and high production costs typical of traditional manufacturing. Warren recognized that textiles offered limited long-term opportunity, but he saw value in the cash the business generated and the corporate structure itself. Berkshire provided a legal and financial shell through which he could eventually deploy capital into better businesses. Chapter 29 emphasizes Warren's disciplined approach during this transition period. He did not rush to make dramatic changes or attempt to turn the textile business into something it wasn't. Instead, he focused on maintaining operations efficiently while searching for superior investments outside the core textile operations. Berkshire became a vehicle for reinvesting earnings into higher return opportunities. Another key point in the chapter is Warren's learning curve in managing a real operating company. While he understood financial statements deeply, overseeing operations required new skills and direct communication with managers. Overall, Chapter 29 marks the beginning of Berkshire Hathaway's transformation, still early, still limited by the textile business, but now under Warren's rational, long-term stewardship. Chapter 30 focuses on Warren Buffett's early years as the controlling owner of Berkshire Hathaway, specifically how he balanced the management of a low-return textile business with his growing ambitions as an investor. The chapter highlights the operational realities Warren faced once he took command. Berkshire's textile division required substantial capital, had weak competitive positioning, and offered minimal prospects for improvement despite competent workers and managers. The chapter explains that Warren approached Berkshire methodically, studying production processes, cost structures, and capital expenditure needs. His analysis confirmed that the economic challenges were structural and industry-wide, not something that better management alone could solve. Despite this, Warren felt a duty to operate the business responsibly. He respected the workforce and the communities that depended on the company, and he was reluctant to shut down the textile operations prematurely. At the same time, Chapter 30 shows Warren's increasing reliance on Berkshire as a capital allocation vehicle. While the textile business produced relatively modest cash flow, Warren viewed those earnings as fuel for more attractive investments elsewhere. This marked the early stages of Berkshire's transformation from a manufacturing company into an investment holding company, even though the shift was not yet formalized. The chapter also highlights Warren's continued appetite for undervalued securities, special situations, and opportunities that fit the partnership-style framework he had developed earlier. He used Berkshire's limited free cash to pursue investments offering higher returns than the textile division could generate. This discipline allowed him to slowly build Berkshire's financial base while keeping the core business functioning. Another theme in Chapter 30 is Warren's maturing perspective on capital efficiency. He increasingly recognized that reinvesting in low-return operations destroyed value, compared to deploying capital into businesses with stronger long-term economics. Overall, Chapter 30 captures Warren balancing operational responsibility with strategic capital deployment, marking a foundational stage in Berkshire Hathaway's evolution toward becoming his primary investment platform. Chapter 31 examines Warren Buffett's expanding use of Berkshire Hathaway as an investment platform and his parallel development as a business owner, investor, and capital allocator. By this stage, Warren's partnerships are performing strongly, and Berkshire, still primarily a textile company, serves as a secondary vehicle through which he is gradually building long-term investment capacity. A key theme in this chapter is Warren's increasing focus on capital deployment efficiency. He understood that the textile operations could not produce high returns, but the company's corporate structure and modest cash flow created opportunities to invest in assets, offering better economics. Berkshire's status as a publicly traded corporation also provided Warren with more flexibility than his partnerships in executing certain types of deals. The chapter highlights Warren's growing involvement in high-quality businesses outside the textile sector. Although he was still in the early stages of shifting away from deep-value investing, he continued to search for mispriced securities, arbitrage situations, and special opportunities. But he was also paying more attention to companies with consistent earnings, strong brands, or competitive advantages. These observations built on earlier lessons from Geico and marked a gradual pivot toward a more qualitative investment framework. Chapter 31 also discusses Warren's personal and professional routine. Operating from Omaha continued to be a major advantage. The geographic distance from Wall Street reduced noise and speculation, enabling Warren to focus on rational analysis. His work environment remained simple: no large staff, no elaborate infrastructure, reinforcing his belief that good investing depends on discipline, not complexity. The chapter further emphasizes Warren's ongoing clarity in communication with his partners. He continued to explain results, decision-making processes, and long-term expectations through concise, principle-based letters that avoided predictions or market commentary. Chapter 31 captures a transitional moment. Warren is still anchored in Graham-style value investing, but increasingly moving toward identifying and owning businesses with stronger long-term economics. Berkshire Hathaway begins to shift from a low-return manufacturer into the early foundation of a future investment conglomerate. Chapter 32 focuses on the accelerating growth of Warren Buffett's investment partnerships during the early to mid-1960s, and how this growth forces him to confront increasingly complex decisions about scale, opportunity size, and investment strategy. The chapter highlights that Warren's strong track record continued to attract capital, giving him more flexibility, but also requiring a more refined approach to finding investments that could absorb meaningful amounts of money. A central theme is Warren's use of categorization, a framework he developed to classify investments into distinct buckets such as generals, workouts, and controls. This system helped him manage the portfolio more intentionally as capital expanded. Generals were undervalued stocks bought at a discount to intrinsic value. Workouts were special situations with defined catalysts. Controls involved taking significant positions that allowed Warren to influence or direct company decisions. Chapter 32 shows how these categories helped maintain discipline and structure in a growing partnership environment. The chapter also describes Warren's increasing interest in control situations, where he could apply rational capital allocation within the company itself. This aligned with lessons he learned through Berkshire. Even though Berkshire was still a limited example of what control could achieve, Warren recognized that controlling an entire business offered investment flexibility beyond what public markets allowed. Another important point in this chapter is Warren's sharpening focus on management quality. While still fundamentally a value investor, he was paying closer attention to the people running the businesses he invested in. Strong, honest, rational managers could enhance long-term returns, while weak or self-serving management could destroy value, regardless of how cheap a company appeared. Chapter 32 also reinforces Warren's disciplined communication with partners. His letters emphasized logical process, margin of safety, and the avoidance of market predictions principles that anchored partner expectations. As assets grew, overall, Chapter 32 captures Warren's evolution from a successful stock picker into a more strategic capital allocator, systematic, structured, and increasingly aware that scale requires selectivity and broader investment tools. Chapter 33 examines the point in Warren Buffett's career when his partnerships reach a level of success that forces him to confront both practical and philosophical changes in how he invests. By the mid-1960s, Warren had built a strong performance record, attracted substantial capital, and refined a structured, disciplined process. But with scale came constraints, and this chapter explores how he responded to new challenges in deploying larger amounts of money without compromising his investment principles. A major theme in Chapter 33 is Warren's evolving perspective on control investments. He increasingly recognized that owning a significant percentage or all of a business allowed him to influence capital allocation directly rather than rely on outside managers. This thinking stemmed from his experience with Berkshire Hathaway and other situations where poor management decisions limited value creation. Warren began considering ownership as a strategic tool for ensuring rational decision-making within a company. The chapter also highlights Warren's growing awareness of market dynamics in the 1960s, a period marked by rising speculation and momentum-driven behavior. Many stocks, particularly in fast-growing industries, were trading far above their intrinsic values. Warren emphasized to his partners that avoiding overpriced markets was as important as finding undervalued opportunities. His discipline in rejecting popular but overvalued investments reflected his adherence to Graham's principles even amid market enthusiasm. Another focal point is Warren's continued refinement of investment categories. The framework of generals, workouts, and controls remained central, but the weighting increasingly shifted as he sought larger, more durable opportunities. Although he still executed cigar-butt strategies, he was gradually moving toward businesses that offered sustainable competitive advantages. Chapter 33 also reinforces Warren's communication philosophy. His letters stressed patience, rationality, and resisting emotional decision-making critical messages as market euphoria intensified. Part 1. The Bubble. Part I introduces Warren Buffett not as a child, but as a fully formed investor, operating in a period of financial excess. The section establishes the contrast between market speculation and Warren's disciplined, value-driven mindset. Rather than participate in the excitement of rising asset prices, Warren remains grounded in long-term fundamentals. This opening framework helps the reader understand why Buffett's approach stands apart. He relies on intrinsic value, patience, and rational analysis. Part I sets the tone for the entire biography by positioning Buffett as someone who resists market noise, operates with a clear internal scorecard, and makes decisions independent of trends. It serves as the philosophical foundation for the rest of the book. Part 2. The Inner Scorecard. Part 2 covers Warren's childhood, adolescence, and early adulthood. These chapters provide the developmental context that shaped his behavior and thinking. Warren grows up in Omaha during the Great Depression, learning frugality, discipline, and independence. He experiments with small business ventures, selling Coke bottles, running paper routes, and reselling used golf balls, developing practical skills in pricing, costs, and customer behavior. The section also introduces his early exposure to financial markets. Through his father's brokerage office, Warren studies stock tables, reads investing books, and makes his first stock purchase at age 11. His experiences teach him emotional discipline and patience, particularly the importance of holding good investments rather than reacting to short-term volatility. In adolescence and early adulthood, Warren deepens his knowledge through self-study, college coursework, and eventually his transformative period at Columbia University under Benjamin Graham. This is where Warren adopts the principles of value investing, intrinsic value, margin of safety, and rational decision-making. Part 2 demonstrates how Buffett's identity as an investor is built step by step through experience, discipline, and mentorship. Part 3. The Racetrack. Part 3 focuses on Warren's early professional career, from working at the Graham-Newman Corporation to launching and expanding his own investment partnerships. He learns firsthand how to apply Graham's methods in a rigorous, structured environment. When Graham retires, Warren returns to Omaha to begin managing capital on his own terms. In this phase, Warren creates multiple small partnerships, each governed by transparent rules and performance-based incentives. He categorizes investments into generals, workouts, and control situations, allowing him to manage risk systematically. As his capital grows, he shifts gradually from pure cigar-butt opportunities to businesses with stronger economics. His early encounter with Geico broadens his understanding of competitive advantages and long-term compounding. By the end of Part 3, Warren's strategy is evolving into a hybrid model that blends Graham's discipline with Warren's growing appreciation for quality businesses. If you're someone in the U.S. trying to build wealth the smart, sustainable way, not through hype, but through long-term thinking, Buffett's story is a roadmap worth following. His habits, discipline, and mindset are repeatable. So if you want deeper breakdowns of each part of the snowball, hit subscribe, tap the like button, and drop a comment telling us which chapter you want next. This channel is here to help you think like an investor, not a speculator. Let's build your financial snowball together.